Unrivaled Nation, today we're going to talk about 3 different stocks. In one case, management believes there's hundreds of percent upside. In the next case, AI really likes the setup, thinks there's over 100% upside. And in the third scenario, insiders like the setup and have been buying tens of millions of dollars of stock recently around current prices. We're going to go through all 3 of these stocks right now. My name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. So the first one, where management believes there's huge upside, is with Tesla, where just earlier today, they announced that Elon Musk is set to get a potential $1 trillion pay package, but it's not so simple because, it's going to be spread across several tranches, a total of 12 tranches that could give him 12% of the company, combined with his prior rewards or awards, that could bring his total ownership stake to around 25-30% of the company. And the tranches have to be tied to both market cap milestones as well as operational milestones. So the first tranche is at $2 trillion, and it needs to be matched with one of these operational milestones, such as 20 million vehicles delivered. This might actually not be too crazy just because this is a cumulative figure over the life of Tesla, and I believe so far they're around 8 million. But either way, there's a lot of exciting milestones here, and the final tranches assume that Tesla gets to a $9 trillion company. So this is clearly Elon Musk saying, yeah, I want to get $1 trillion ownership pay package, but it's only if I create this huge value. I'm creating trillions of dollars of value for Tesla shareholders, and it's going to be driven based on either vehicles delivered. That's actually, I'd argue, one of the less significant of these components. The other is the 10 million full self-driving subscriptions, 1 million robots delivered, and 1 million robo-taxis in commercial operation. The bigger and arguably more relevant target, that those are all helpful operational targets, but what's going to drive that potential multi-trillion dollar aspiration is that they have to grow their core profitability, their EBITDA, adjusted EBITDA, and their aim is to grow it to around $400 billion in the next 10 years. That's the goal. Now, I think it's important to look at where they are versus what they're aspiring for, but this is clearly very excited to say, hey, we want 1 million robots delivered in the next 10 years. That's a commentary about the future that they see. And Elon Musk saying, I'm really only going to get paid if we deliver on some sort of exciting multi-trillion dollar future for Tesla shareholders. Now, currently, Tesla has around a $1.1 trillion market cap. So going from 1 trillion to 8 trillion over the next decade could be a very satisfactory journey for investors, but it's going to require just Herculean efforts to scale this business, because right now, to give you a perspective on their EBITDA, it's currently between, let's say, 11 and $20 billion. It actually has been coming down and been under pressure recently. So their goal, and in order to get to $8 trillion, ballpark figures, it will require hundreds of billions in EBITDA per year. They're nowhere near that today. So management is saying, look, this is what we believe. This is what we're aspiring, this is what we aspire for. This is what we think we can do. And, it is kind of interesting, just to think about that future. I'm hopeful for it. I never want to bet against Elon Musk. He's achieved incredible things. It was funny. There was even a Burning Man exhibit recently where it had like F Elon Musk, but it was powered by Starlink. So even the haters are using his products. And so it's amusing to me to see all this. It's clearly exciting to think about their future, but it's going to require just a complete reversal of the recent trends of EBITDA declining. It's going to require, frankly, hitting their first market cap milestones that they did with the 2018 package was, in my opinion, a large part due to valuation expanding so much. This next 10 years, in order to get to a $1 trillion pay package, you're going to have to really see the fundamentals drive the return going forward. You're going to have to see, just look at the difference. The difference between, $10 billion in EBITDA and $1 trillion market cap. That's a huge valuation multiple versus, going to $400 billion in EBITDA and 8 trillion. That's a huge compression in terms of valuation. So, and I think, about my checklist, this is clearly management believes a lot of upside, 6, 7, 8 times upside over this next decade if they deliver and execute. And that could give, Elon Musk $1 trillion of additional value through this effectively 12% of the company. But I look at this and I view this pay package as aligned management. Yeah, that checks out, where they're saying we're going to try to just go crazy and look at what we can build and deliver. And I'm excited about the robots. Look forward to Westworld. As I've said before, white hat most days. In terms of compelling valuation, it's nowhere near that. In terms of obvious growth potential, yeah. So for my own personal investment journey, and this checklist, frankly, most companies fail. And I'd argue Tesla doesn't pass the compelling valuation threshold. Just because it's, looking at where they are now, there's a huge disconnect between fundamentals and market cap. I think based on where they are now, based on their EBITDA now, you could have, a market cap much lower, easily half of its current price. And I think you could also have a situation with Tesla where they could prove out, let's say they prove out their EBITDA going from, 10 to 20 billion to 100 billion. And it's possible the stock stays flat over that time period. So that is not uncommon for high growth companies to do that, where the underlying fundamentals do go really well based on a promising future and exceptional execution. But Wall Street, got a little too excited, and now it's sort of working it off over years. Would not surprise me at all if that's what ends up happening with Tesla. So that's the the first one. Clearly, management believes tremendous upside. The next stock is Lululemon, stock down around 20% today, following their latest earnings report, talking about weak demand and trade policies, tariffs that are hurting their results. And you could see not only did the stock lose between 15 and 20% today, but zooming out over the past 5 years, it's just been a horrific ride, losing over 50%, significantly underperforming the broad indices. Management also lowered their guidance again. At this point, I wouldn't even put out guidance. I've expressed that before. Only put out guidance if you think you can beat it. That's sort of the mentality, because if you get behind the 8 ball, where you repeatedly have to lower guidance, it makes it look like you don't know what you're doing and you're not in control of the business. That is way worse than not putting any guidance out at all. It comes back down to what's the upside of doing this versus what's the downside. And the downside of repeatedly missing means arguably you could see management effectively get replaced. Wouldn't surprise me at all. So their new guidance, worse growth, 2 to 4% growth that they're expecting this year, 4 to 6% if you add back an extra week that they had in 2024, looking around $12, $13 in earnings, closer to $13 in earnings, around a 30% tax rate. They are expecting around $240 million hit, primarily due to higher levels of tariffs. This is the Trump tariffs that they were talking about. So that will impact their gross margins. This is an example of, maybe eating it a little bit. But still, it is important to step back and, look at what's actually driving their results. And, it's not just a one-off Trump tariff. What you're looking at here is arguably a very weak, very soft North America environment where U.S. or America's comparable store sales are down 4%. That means you're rapidly contracting, or in my opinion, you're rapidly losing market share potentially to other players. So that is a red flag, and it's not a good sign when you're showing potentially that you're losing market share to some maybe fresher brands out there. However, their international exposure, their comparable store sales doing really well. China as a region growing around 25% growth. So this is a story of different regions where the Americas clearly coming under pressure, Rest of world, much better. International growing 22%, and a comparable store sales really crushing it around 17%. But when you net it all together, because international is so small relative to the Americas, it only nets out to around 1% for comparable store sales. So this is not great. But when you take a second to think about where they are, once again, management guiding to around $13, just shy of $13 in earnings, and where the stock is now, that suggests it's around 13 times earnings. So it's important you always need to think about these different components. 13 times earnings. If you do the inverse of that, the shareholder yield, that means 1 divided by 13, that implies about a 7 to 8% yield. So assuming zero growth, and clearly international is doing well, assuming zero growth, you're getting shareholders get 7 to 8% yield, meaning management can use that to build up their cash balances. They can acquire companies. They can buy back stock. They can do a dividend of 7 to 8% per year if they wanted to. It's really up to management. And arguably, the lower this gets, the more interesting it gets for an activist to say, like, what's going on? We need new management or, some sort of pressure. But this sort of framework is what drives your future returns, because 7 to 8% yield, then you throw in a little bit of growth. Now you're talking about teens. And then if you throw in a little bit of a little bit of valuation expansion, because investors say, hey, maybe this isn't a dying brand, and then it goes higher. Now, I don't own any Lulu, and I've talked about it in prior videos, and the key part of it is that I have trouble thinking about where this brand's going to be in the future. Right now, clearly crushing it in China, as I already called out. International growing 22%, America's closer to flat. So that's the challenge is this obvious what this looks like in 5 to 10 years from now? And in my opinion, once again, running, a stock through the checklist stays the same, run it through different companies. I'm not sure the aligned management is there. I'd say the compelling valuation, unlike Tesla, I'd say here, this is much closer to a compelling valuation, around 13 times. But the growth potential, it's just not obvious to me. Yes, you're winning in China now. What's that look like in 3 to 5 years from now? Is it still a hot brand then? Or does the brand in North America completely implode? Do people go in the stores and say, hey, I don't like what I see? I have seen a lot of favorable comments from guys posting saying, one, I like how it looks on my, significant other, but two, these are like the most comfortable pants I've ever worn. So you are seeing that sort of dynamic, but I don't see how the consumer is going to spend more on this over time. Maybe it happens, but it's just not obvious to me. I would prefer situations where, similar to Tesla, where management says, this is why we're going to double the business. And if I go through each of my holdings personally, I can go like, oh, this is management's target and this is with their vision. And, they've talked about doubling the business. You don't really have that here with Lululemon. You don't have this very obvious growth potential of like, oh, this is going to be 100% bigger where they are. They put out guidance a few years ago. They haven't really updated to saying, hey, our new 2030 figure is we're going to be 100% bigger. And I frankly, I don't think they could even justify it based on their current results. So once again, another stock that fails my personal checklist. So I'm not buying Lululemon, but this was something that AI really liked. And I'm the co-founder of Flash. You can see the link below that leverages the most cutting edge AI models available. And any company you want to see, it's free to use for you to check out. And Flash looked at it and said, hey, I like AI. That's what Flash was saying it had over 100% upside, saying if they were able to get a return to U.S. momentum, then the stock could really rip higher. So far, we're not seeing it. And it called out that one of the premium features of Flash, something, a small price for a monthly subscription, it calls out best ideas. It called out Lulu several times, I think 5 times now. And despite significantly underperforming, the Lulu significantly underperforming, the best ideas picked from Flash have actually, as of this morning, so I think at this point, when this chart updates, I think 2 or 3 times a day, at this point, Lulu was down, I think 15%. So it might get a little bit worse from where it was, but still, since we launched this, and this is sort of crazy and exciting for me. this is entirely driven based on AI looking at the reports that it's generated to say these are the most compelling 6 ideas, each week, based on all the reports that it can see, and focusing primarily on the more recent ones, data gets stale over time. But you can see it's actually outperformed the S&P and the NASDAQ by a couple percent. That's since June. No idea if it'll continue to do this, but this is an example of AI clearly liked the story with Lulu, called it out several times. We'll see what happens. I'm not sure if AI will continue to call it out, if Flash will continue to call it out in the months ahead. I don't know if Flash will underperform in a year from now. It doesn't follow my personal checklist of, boop, 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 the management alignment, obvious growth, compelling valuation. But based on AI, this is saying these are the ideas, and so far it's outperforming. So far we've covered 2 ideas. Tesla, where management believes, there could be tremendous upside, literally, going from $1 trillion to $8 trillion market cap over the next decade, based on this futuristic vision of robots and full self-driving. Lululemon, it's more AI's getting excited about it just because of, look at the valuation. Historically, this was a great brand. International's doing well. If North America just stabilizes, there's a potential for this to rocket higher. So we're going to talk about that third stock with huge insider buying in just a second. First of all, none of this is financial advice. I'm just sharing my thoughts on these different companies. And also, quick plug, Sebastian, a premium unrivaled subscriber, recently shared, thanks for giving us an affordable platform to not only follow your investment ideas, but more importantly, ask questions along the way. He's talking about our premium subscription, which has a Discord offering where I'm very active sharing and answering questions in our exclusive Discord. And so for that premium tier, the price will be going higher in the next month or two. So now is the time to lock it in, because prices will be going up. This follows Christos S., who posted, keep rocking, love your no hype, no BS approach. That's what I aim for. So if you're looking for compelling ideas, come check out Unrivaled Investing. So the third idea, based on, in this case, insider buying, and this is another feature of Flash where it looks at, you can sort by different ideas. In this case, it's by insider purchases. You can see there's been tens of millions of dollars of insider buying in a stock called REZI. Resideo Technology, REZI is the ticker. Most recently, just a couple of days ago, the chairman purchased $1 million worth of the stock, around $34, just shy of where it currently trades today. And then over the past few weeks, you have one of the largest holder of the company, a private equity firm that owns over 10% of the company. They've been aggressively buying tens of millions of dollars worth of the stock. So clearly, when you see that type of buying, the only reason why insiders buy is because they're expecting to get an attractive return. That's what I suspect is going on here. When we look at Resideo Technologies, REZI, it's an interesting company with really 2 different core subsidiaries. You have the Resideo subsidiary, which is a manufacturer of building products. So this is focusing on residential controls and sensing solutions. Think about security, energy, water, air. This is about making your home, the systems that make your home more comfortable. They are the builder, the manufacturer of that, and they have their own brands, the Honeywell brand, the First Alert brand. So it's about owning those brands, and then it's purchased by consumers or by distributors, installers that say, hey, we want to make sure we have a proper AC unit, or we have a proper security system set up. Then they also have a distributor system, ADI, which this is all over the place. This is wires and cables, networking, video surveillance, fire, residential, so this is a whole bunch of different brands. This includes the brands that they own. So you can see a bit of a conflict of interest, especially with their distribution business, because one includes their own brand and the other, includes a whole bunch of other brands that they're potentially marketing. And what's interesting about the setup is they're expecting to, first of all, it was a spinoff from Honeywell. So Honeywell just keeps breaking apart and spinning off new subsidiaries. So this was from a couple of years ago. They spun off Resideo from 2018. They're expecting to make a sizable $1.6 billion payment to Honeywell very soon. So that payment was made in July. So you're going to see it in the financials for the third quarter. this was otherwise a multi-decade agreement to license effectively the Honeywell brand name, paying about $140 million a year. So their view is that paying this amount to Honeywell will actually help their free cash flow on an annual basis, just because it's going to be one lump sum where they're going to be borrowing probably around $1.2 billion in debt for this Honeywell payment. And on going forward, their free cash flow will look even better. And this is an interesting example where I can understand why management, finds this attractive, which is that even though debt is going to go to gross debt, based on this new, Honeywell payment is going to go to $3 billion, their free cash flow might be, adding back the amounts that they were previously paying Honeywell, might be $450 million per year. You need to factor in some interest expense, but $450 million in free cash flow per year for this. And, roughly a $2-3 stock, closer to $3 versus the $35, share price now, once again, around 13 times earnings. So it's a similar sort of story to Lululemon in terms of valuation story. But in this case, management clearly believes there's a lot more upside potential with this company over time. So this is an example where it previously spun off and then management said, hey, we're going to split it up again. We're going to split up this Resideo segment and the distributor segment. Very curious to see how that plays out. I'm not, the story is still a little early for me in terms of digging into it, but it does strike me as interesting, especially when you have insiders, putting up tens of millions of dollars and the stock's moving higher and it trades at 13 times, earnings / free cash flow. So very interesting development. So those are the three different situations where either management sees a lot of upside, AI sees upside, or insiders clearly see upside. I hope this video has been helpful for you. I hope you have a great weekend. Thanks so much for watching Unrivaled Investing.